Right now, your family cannot touch a single dollar in your bank account if you died tonight, not tomorrow, not next week. A will would not help them. A notary would not help them. An attorney-drafted estate plan would not help them. There is one free form, one that bypasses all of it. And the reason most people have never been told it exists is simple. Nobody whose job depends on the current system has any incentive to tell you. My name is Lona Maines. I represent taxpayers directly in front of the Internal Revenue Service. I sit across the table from the IRS and from bank compliance officers on behalf of real people. If this kind of information is useful to you, hit subscribe, because every week I break down the financial and legal facts that protect your money and your family, and I make sure you actually understand them. The single most preventable financial disaster I see is not a bad investment. It is not a tax mistake. It is a family standing at a bank counter the week after a death being told they cannot access a cent of money that was legally theirs because one form was never filed. That form takes 10 minutes. It costs nothing. It requires no attorney, and you will never be told about it unless someone like me tells you. The legal framework that still controls your money, the Uniform Probate Code finalized in 1969 by the National Conference of Commissioners on Uniform State Laws, established something that most Americans have never been told. It classified financial accounts held at banks and credit unions as contractual instruments sitting on a completely separate legal track from your will. States adopted this framework over the following decades, and every state in the country now operates under some version of it. Courts have reinforced it in case after case ever since. What that means, in plain terms, is this. The contract between you and your bank, not your will, not your trust, not your estate plan, governs what happens to your money when you die. A signed beneficiary designation on a bank form overrides a notarized, witnessed, attorney-drafted will every time, without exception. The will controls your furniture, your car, your jewelry, the physical property in your home. The bank contract controls your cash. If you die without a named beneficiary on your bank account, the account does not transfer to your heirs. It transfers to your estate, and the moment it transfers to your estate, probate is triggered automatically. Probate is the court-supervised process of validating your will and distributing your assets under judicial oversight. Most states set probate thresholds between $50,000 and $100,000. If your account balance exceeds that threshold, and for most retirees it does, your family waits. The court moves on the court's schedule, not yours and not theirs. Here's what people do not understand about probate. It is not a fast administrative process. In most states, there is a mandatory creditor waiting period of 3 to 6 months built into the law. Unknown creditors, medical providers, credit card companies, anyone who might have a claim against the estate must be given time to come forward before any distribution can occur. Your family cannot receive a dollar until that window closes, regardless of how clean your finances were. And during that entire period, your bills keep running. The funeral does not wait. Grief does not come with a financial timeout. That leads directly into Dorothy's story. Asterisk, she did everything right. It did not matter. Dorothy was 71 years old. She was a retired school teacher from Illinois who had sold the family home and walked into her local bank with $350,000 from the proceeds. She opened a standard savings account, hired an estate attorney for $800, and had a comprehensive will drafted, witnessed, notarized, and clearly naming her 2 adult children, Michael and Sarah, as equal beneficiaries. She put the will in a locked box under her bed and called Michael to tell him everything was handled. It was not. Dorothy suffered a stroke and died. Michael and Sarah flew in, received an $11,500 funeral invoice, and Michael took the death certificate and notarized will to the bank. The branch manager looked at the account screen, looked at the will, and slid the documents back. Dorothy had never filed a payable on death beneficiary designation. The account held only her name. Because the balance exceeded the state's small estate threshold, the bank had no legal authority to release a single dollar. A will is a letter of instruction addressed to a probate judge. It carries no weight at a bank counter. The bank's obligation runs to the contract on file, and the contract on file named no beneficiary. The account was frozen. Michael and Sarah walked out of the bank with nothing. They put the $11,500 funeral bill on their own credit cards, paying interest rates that were running well above 20% at the time, rates typical of consumer credit cards, while $350,000 of their mother's money sat 20 feet away behind a counter they could not legally cross. Then the probate process began. The court filing fee to open the estate was $389. A secondary publication filing required by Illinois law to notify unknown creditors through a local newspaper for 3 consecutive weeks cost $250. The executor bond premium cost $1,000. These were just the entry fees. The probate attorney charged a percentage of the gross estate, which is standard practice in many states. On an estate of this size, that came to over $10,500. The mandatory creditor waiting period held the case open for months. From start to finish, the family waited 14 months to access their mother's money. They lost over $12,000 in documented fees, and the interest accumulating on the credit card they used for the funeral kept running the entire time. Dorothy did nothing wrong. She had the will, the notary, the attorney. None of it reached inside a bank contract. Her situation was not a legal error. It was not unusual. It was the entirely predictable result of a system working exactly as it was designed to work, and it has 3 specific entry points where families fall into it. Before I walk you through those 3 failure points, open your online banking right now, or pull out your most recent bank statement. Look for a beneficiary field. If you cannot find one, or if it is blank, that is already your answer. Write down what you see, because what you find determines exactly which of these traps you are sitting in. 3 ways people accidentally lock their own money. The first failure point is no beneficiary designation on file at all. This is the most common situation I encounter. You opened the account years or decades ago. Nobody at the bank asked you to name a beneficiary. You signed the signature card and left. You assumed your will would handle it. It will not. Under the contractual framework now codified in state law across the country, a will has no authority over a bank account. The account defaults to the estate. Probate opens automatically. For a lower-income retiree, this is often catastrophic. A 6-month probate process on a $60,000 account can consume a meaningful slice of that balance in filing fees, attorney fees, and publication costs before a single dollar reaches the family. For the comfortable middle-class retiree, the assumption is usually that the estate attorney already handled it. Most estate attorneys draft wills. They do not file bank beneficiary forms. Those are 2 completely separate documents at 2 completely separate institutions, and almost no one explains that to you when you write the check for the estate plan. The second failure point is an outdated beneficiary designation. This one is more dangerous than no designation at all, because it gives you a false sense of security. You named someone 20 years ago, an ex-spouse, a parent who has since died, a sibling you no longer have a relationship with. That name is still on the form. That is who the bank sends the money to. The will says something entirely different. It does not matter. The uniform probate code in every state that has adopted it are clear. The designation on file at the bank controls, period. Courts have consistently ruled against surviving spouses, adult children, and estate executors who believed a current will would override an old bank designation. It will not. The bank looks at the form on file, not the document in your lockbox. The third failure point is the joint ownership assumption. Many married couples believe that because they are married, all accounts automatically transfer to the surviving spouse. In a number of states, that is simply not true. Joint tenancy with right of survivorship is a specific legal arrangement that must be explicitly created and documented at the bank. Marriage alone does not establish it. The account structure, the title on the account, and the state-specific treatment of marital property all determine what happens, not the marriage certificate. And there is a trap hidden inside the most common attempt to fix this. Many seniors add an adult child directly to their account as a joint owner, thinking it gives their child easy access to pay bills if something goes wrong. The intention is good. The legal consequence is severe. The moment you add another person to your account as a joint owner, the law in most states treats that money as partly theirs, right now, while you are still alive. If your child is in a car accident and faces a lawsuit, the plaintiff can pursue your bank account. If your child goes through a divorce, their spouse can claim a portion of your savings in the settlement. If your child has a tax debt, the IRS can levy your account to satisfy it. Joint ownership transfers your exposure to every liability your child carries immediately and completely. The POD designation avoids all of this. It grants your beneficiary zero ownership rights while you are alive. Your money stays entirely yours, entirely protected from their creditors, until the moment you pass. Then the transfer happens cleanly on contract with no court involved. All three of these failures have the same fix, one form, free, available at your bank right now. So here's what I want you to do. The exemptions, the breaks, the refunds most seniors already qualify for but never claim. I've put them all in one place, state by state, form by form, so you don't waste hours digging through government sites. Everything's laid out fast and simple, so any senior can find exactly what applies to them. No matter what state you're in, there's money you're leaving on the table. It's called the Senior Exemption Playbook. It's in the first pinned comment right below this video. Just tap it once, and you'll have everything you need. Now, stay right here because the last section covers the one form that makes all of this go away, and it's the reason I made this whole video. The form that makes probate irrelevant. The form is called a Payable on Death Designation or POD. The concept traces to a New York court decision called Matter of Totten in 1904, which established that money could transfer directly to another person upon death without a formal trust or court involvement. That principle was codified in the Uniform Probate Code Section 6 to 101 and adopted in some form across all 50 states. It is not a will. It is not a trust. It is a contractual instruction to your bank operating on the exact same contractual track that froze Dorothy's accounts. Because it operates on that track, it bypasses probate entirely. The bank never looks at the probate court. It looks at the designation on file. When a valid POD is recorded, your beneficiary presents a certified death certificate at the bank. The designation is verified, the transfer is processed, no judge, no attorney, no filing fees, no mandatory waiting period. Processing time varies by institution. Smaller banks may handle it the same day or next business day. Larger institutions typically take 3 to 5 business days. What it does not take is 14 months. The cost of filing a POD designation is zero. Every FDIC-insured bank in the country is required to offer it. Every federally insured credit union offers an equivalent. There is no fee to file it. There is no annual fee to maintain it. It costs nothing because it generates nothing for the bank. It serves only you and the people you name on it. What the POD form does not cover, and what to file instead. Here is where most people stop and where most people leave gaps. The POD designation covers your individual bank accounts, checking, savings, money market. It does not automatically extend to every financial instrument you hold, even at the same institution. Certificates of deposit require a separate designation. A CD sitting at the same branch where you filed your POD for your checking account is not covered by that form. Each account is its own contract. Each contract requires its own beneficiary designation. If you hold 3 CDs at the same bank, each one needs its own POD filed separately. Brokerage accounts use a different form entirely, called a transfer on death designation or TOD. It operates on the same legal principle as a POD, direct contractual transfer outside of probate, but it is filed with your brokerage firm, not your bank. If you hold stocks, bonds, or mutual funds in a brokerage account with no TOD on file, those assets go through probate just like an undesignated bank account. The bank never looks at the probate court. It looks at the designation on file. When a valid POD is recorded, your beneficiary presents a certified death certificate at the bank. The designation is verified, the transfer is processed, no judge, no attorney, no filing fees, no mandatory waiting period. Processing time varies by institution. Smaller banks may handle it the same day or next business day. Larger institutions typically take 3 to 5 business days. What it does not take is 14 months. The cost of filing a POD designation is zero. Every FDIC-insured bank in the country is required to offer it. Every federally insured credit union offers an equivalent. There is no fee to file it. There is no annual fee to maintain it. It costs nothing because it generates nothing for the bank. It serves only you and the people you name on it. What the POD form does not cover, and what to file instead. Here is where most people stop and where most people leave gaps. The POD designation covers your individual bank accounts, checking, savings, money market. It does not automatically extend to every financial instrument you hold, even at the same institution. Certificates of deposit require a separate designation. A CD sitting at the same branch where you filed your POD for your checking account is not covered by that form. Each account is its own contract. Each contract requires its own beneficiary designation. If you hold 3 CDs at the same bank, each one needs its own POD filed separately. Brokerage accounts use a different form entirely, called a transfer on death designation or TOD. It operates on the same legal principle as a POD, direct contractual transfer outside of probate, but it is filed with your brokerage firm, not your bank. If you hold stocks, bonds, or mutual funds in a brokerage account with no TOD on file, those assets go through probate just like an undesignated bank account.